Most rideshare drivers are paying the IRS an extra 4 to 8 grand every single year, and they don't even know it. If you're driving full-time or even part-time, the IRS lets you write off a huge chunk of what your car cost, but only if you choose the right method and actually track it. In this video, I'm going to break down the 2 ways to write off your car, show what else you can deduct, and walk you through exactly how I track everything in Gridwise, so I'm not guessing at tax time. Today we're talking rideshare taxes from a driver's perspective, specifically how to write your car off the right way and stop overpaying. We're going to keep this simple and practical. The 2 ways the IRS lets you write off your car, what other business expenses you can still deduct, and how I personally use Gridwise to track all of it in the background. I'm not a tax pro, so always double check with a CPA or a tax software for your situation. But this is a system that helps me keep more what I earn. Let's start with why drivers get burned at tax time. Most of us think Uber and Lyft show me my earnings and my miles. I'll just download the report in April and I'm good. Well, the problem is those reports don't always reflect these. The miles that you drive when you first go online to that hotspot or pickup, the deadhead miles in between trips while you're still online, the miles heading home after your last ride. On top of that, many drivers don't understand the 2 car deduction methods, so they either try to stack mileage and car expenses, which you can't do, they underdeduct and leave money on the table. The way around that is understanding the 2 choices for the car and then tracking properly. So let's break these choices down. The first option the IRS is going to give you is a per mile deduction. And this is the most high mileage rideshare drivers end up using. Here's the idea. Every year, the IRS sets a cents per mile rate for business driving. So you track how many business miles you drive for that year. At tax time, you multiply business miles by that rate. Then that's your car deduction. So if the rate is around 70 cents per mile and you drove 20,000 business miles, that's about $14,000 deduction just for your car use. Now, that 1 per mile number is meant to cover gas, oil changes, routine maintenance and repairs, tires, and depreciation on your car. If you choose the per mile method, you do not also list out those same car costs again as separate deductions. They're already baked into that rate. The big benefits of that, it's simple, and if you drive a lot, that deduction can actually be huge. Option 2 is the actual expense method. With this one, you ignore that per mile rate. Instead, you're going to add up what it really costs you to own and operate that car for that year. So you're going to add up gas, oil changes, maintenance, repairs, tires, insurance, registration, and maybe some of your interest on your car loan. Then you figure out what percentage of your total driving was for business versus personal and apply that percentage to those costs. So if your car cost $10,000 for that year and about 80% of your driving was for rideshare, you might get around an $8,000 car deduction. Now, this method works better if you don't rack up many miles or if your car is very expensive to run and you had big repairs. The downside, it's more work. You need good records of each of those expenses and a way to prove how much the car is business versus personal, just in case you get audited. So which one should a rideshare driver actually use? Well, there's no single right answer for everyone, but here's a simple way to think about it. If you're putting a lot of miles on your car for Uber or Lyft, that per mile method usually gives you a bigger deduction and it's easier to track. And if you don't drive that much, but your car costs are very high, that actual expense method might be worth a closer look. Here is a quick example so you can see the difference. Let's say you drive 25,000 business miles. Under that per mile method of at around 70 cents, you're going to get about $17,500 as a car deduction. Now imagine if your actual car costs, gas, repairs, insurance, everything adds up to $11,000 and it's mostly for work. Under that actual expense method, you earned around $11,000 car deduction. In that situation, mileage wins pretty clearly, $17,500 versus $11,000. Whatever gives you the bigger legit deduction is what you and your tax pro will want to use. But either way, you only get to choose one of those methods. Now here's where a lot of drivers get tangled up. The choice between per mile and actual expenses is only about how you write off the car itself. On top of that, there are other business expenses you can usually deduct either way, as long as they're ordinary and necessary for driving business. Now, those things can be a reasonable portion of your phone bill because you're using your phone to run the apps and navigation. Phone mounts, charging cables, extra charges that you keep in your car for the passengers, cleaning supplies, car washes, all those things, tolls, parking, all that stuff that you use, that you incur while driving because you run the business or you're doing rideshare or using that car for business. So the formula looks pretty simple. It's just like this. You pick one method for the car, mileage or actual expenses. Then you layer on those other legitimate business costs on top. The trick is not just knowing the rules, it's actually tracking this stuff. That's where I lean on Gridwise. So now you're going to see a screen recording. What's going to pop up is going to be Gridwise. Now you can see right here, it says mile deduction for 2026. Earnings $16,664, shows the deduction, all that. I didn't add any expenses in yet. But when you go up here, it says classify entries. It actually tracks all the stuff. I can go business or I could go personal. This one was business. I could do it for Uber or I could do taxi for private, whatever. I can track it like that. But what you have to do is you go up here to Gridwise Plus and you're going to go to mileage tracking. I do automatic tracking. So every time I turn the car on and off, it automatically tracks those trips. So when I stop and I go somewhere after so long, it stops tracking. You could set the rates. But that way you don't have to remember every time, because if you manually track it, it's going to be hard. You're going to forget. This way you're tracking on the way to pick up somebody, deadhead miles, and on the way home. You could go back throughout the day and you could switch and you can actually choose which ones were business, which one were actual personal miles. And that's where the classify entries come up. I could do all that stuff. So that way you guys know exactly how to do that. But it's going to show your miles deduction. You can send it to your CPA. You can export it as a PDF. You can do all that stuff. But it shows everything you do, business mileage. It tracks all that other stuff. I just wanted to show you guys, you can do right here, export PDF, CSV, or a zip file. That way you can do all your receipts, your mileage tracking, all that could go to your CPA if you use one, or you can upload it to your tax software when you do the taxes. But using Gridwise just makes it easier when it comes to tax time, but also great for the airport. That's what I mainly use it. This is actually just a bonus. All right, now I've explained everything to you. For your car, you have to pick one method each year, per mile deduction or that actual car expense method. You can't stack both of them. If you're a high mileage driver, mileage is usually the winner, and it's a lot easier to track. On top of that, you can still deduct other business expenses like your phone bill, mounts, cleaning supplies, tolls, and parking. And when you're using something like Gridwise to track your miles, your earnings, and your expenses as you go, tax time becomes a math problem, not a guessing game. If this helped you understand it, please like and subscribe to the Gridwise channel, and hope you guys enjoy this. I know it's a little late after tax time, but hey, it's better start now than never.